Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, I'm a senior market specialist at FXCM. And my email address is rshort@fxcm.com. Today is Monday, it's the 1st of August 2022. Nice to be back. I had a week off, so really nice to be back. And I didn't really look at the markets at all last week, so when I came back and was just going through some of the releases over the last week, certainly some surprises there. I'm going to just bring up our high risk investment warning. I'll keep this on screen. So I guess for me, the comment that the Fed's at the neutral rate, I don't think that's right. I don't think they're neutral. So what is neutral? Neutral means there is no, it's kind of, you at equilibrium. There's not going to be inflation pressures. There's no pressures on unemployment. And I don't see how that's possible. Nevertheless, it's not really an observable rate. By the way, it's very much a theoretical rate. Neutral, so you'll hear something called R star. R is the textbook way of referring to interest rates. R star, that's neutral. So it's a very much a theoretical and debatable number amongst economists. I'm just going to bring up market commentaries disclaimer. I'll keep this on screen for a few moments as well. Hey Raj, good morning to you. Nice to have you on the webinar. Thank you everyone for joining. Okay, and just our references, MarketScope, CNBC.com, and TradingView. I'm just going to bring up this screen on TradingView. We'll go through the CNBC article as well, just to set in the headlines. In terms of what you're looking at, I think we can get rid of this guy here. What you're looking at here is our real rate. This is quite a big surprise to me, so we're going to have to talk about this. And the whole idea here, just by the way, is to try and get our trades aligning with the fundamentals, right? So that's the whole goal. All right. So the CNBC article for Europe reads as follows: European markets set to kick off August trading with a mixed open. European stocks are expected to open in mixed territory on Monday, kicking off August trading on uncertain footing. The mixed open anticipated for European stocks today comes after the region's markets closed the month of July higher on Friday and logged their best month since November 2020. So the best month since November 2020, I think the obvious question we've got to ask is, have we bottomed? And of course, peaks and troughs are only really evident in hindsight, but as traders, we've got to try and do our best to come up with some sort of sensible approach to see if we have reached a bottom. So we'll take a look at that as well. Investors digest a fresh swath of corporate earnings and key economic data out of the Eurozone, digested, I think, out of Euro last week, with data released last Friday showing economic growth in the Eurozone accelerating in the second quarter, despite the escalating gas crisis and record high inflation. The 19-member bloc posted a 0.7% rise in gross domestic product, exceeding expectations for growth of 0.2% and contrasting sharply with a negative annualized reading out of the US in the first and second quarter. So GDP contracted in the US over two consecutive quarters. But that's a technical recession, right? Elsewhere overnight, US stock futures fell following Wall Street's best month since 2020 as investors look ahead to another week of key earnings reports and economic data, particularly Friday's non-farm payrolls. Okay, so we'll do a live trade on Friday. I haven't set it up because I've been away last week. I'll set that up today. I'm just making a note here. So if anybody wants to join us on Friday, we'll do a live trade on Friday. Okay, so we want to just give an idea. We want to get an idea of what's going on with the labor market. Okay, so we're going to take a look at that today as well, but we're not going to look at it in terms of payrolls. We're going to look at it in terms of jobless claims. Let's see if we can get some sort of information out of that. So far this year, the solid growth of jobs has prompted economists to say the US is currently not in a recession, even with 2 consecutive quarters of negative GDP. Okay, so the technical definition is 2 quarters of negative GDP. The economists saying we're not in recession, and solid growth of jobs. Okay, so jobs might be lagging. Okay, so we can talk about that as well. Okay, just talk about just to set the tone for the week, and then we'll develop this as the as we do our reviews each day. In Asia Pacific markets, mainly in China, stocks rose along with most other regional indexes on Monday as a private survey on China's factory activity showed slight growth. Earnings are set to come from HSBC, Credit Suisse, Pearson, Heineken, and data releases include Eurozone unemployment figures for June and final PMI Eurozone data for July. Okay. A fair amount on our plate this morning. I think a good place for us to start is, of course, with the chart that we have right here, and this is the real rate. Okay, so let's just make some notes here. Hey Howard, morning to you. Nice to have met you. I met Howard. He came up to Joburg just over a week back. It was very nice sitting down having coffee with him, and looking forward to doing that in the future. All right, let's just put some text in here. All right, so what we're looking at here is real rates. Okay, real rates. Now, this is actually quite important for us, and we've got to monitor this. So we're going to come back to screen. I'm going to just take off this part, okay, of the function. Just delete it. We're going to go back to US 10 years. So we just go back to, so now this is the US 10-year yield. And let's just understand what we're looking at here, and then we'll go back to the real rate. So we're looking at, in fact, let's take this moving average out as well. So we've just got this 2.66. So what is this 2.66%? So the definition of what we're looking at here is, well, we're looking at what's called a nominal interest rate. Okay, so let's just bring in the function for nominal rate. So nominal interest. Okay, nominal interest. And when we go into the bank, and we see an interest rate, that is a nominal interest rate. We're all very familiar with nominal interest rates. So nominal is just sort of a phrase used by economists to differentiate between real rates and real rates adjusted for inflation. So nominal rates would be real interest, plus there has to be some sort of inflation adjustment. So let's just talk about this so that there is no confusion. If you are in an inflationary environment, and we are, and we have deposited money in the bank, then we expect the bank to give us a higher rate of interest. And that means that they are adjusting, for this inflation. So they're adjusting the real rate with an inflation adjustment, and we should theoretically get paid a nominal interest rate. But what's really important, depending on where we are in the business cycle, at the moment, this guy is dominating. Last year, it was this guy that was dominating, because remember the conversation we had with, is inflation temporary? Is it transitory? Is it more sustained? Is it more permanent? Well, that put all the focus on the adjustment. That's out the window. We know that we've got inflation. We know. So all the discounting that's taken place on the inflation side It's now up to the Fed. Okay, what's happening on the real interest rate? Okay, and this is what is this is what's really important for us, because it's going to drive the market. As traders, we want to know what's driving the market. So let's just rearrange this slightly. Okay, let's just rearrange this. So we're just going to use basic math. So we're going to go like this. Okay, so we're going to go real rate equals the nominal rate, and it must be minus the inflation adjustment. Okay, must be minus the inflation adjustment. Okay, so if you just bring the inflation over to the side, it's going to become a negative. So these are related, let's call them functions. So this guy over here, now think about this very carefully, this guy here, we are in uncertain, we're in an uncertain market. We're in an uncertain market. So if your real rate, okay, goes positive, because at one stage it was negative, then that means you are getting an inflation beating interest rate when you go into an instrument that gives you a decent rate. Okay, so just a bit of math here. Let's just say, remember last year there was no real interest rate. We were artificially low. So let's just assume a nominal rate of 1%, and we can go minus 2%. Okay, let's just say inflation was rising at 2%. Well, then we've got a real rate of minus 1. Okay, so this is all kind of now, wait a second, Russ, you're confusing me. What do you mean we've got a minus real rate? Okay, understood. Now we're going to bring up this chart over here. We're going to go US 10-year minus, we're going to put in an instrument called the US 10-year break even, which makes the inflation adjustment for us. Okay, and now it's going to make a lot more sense because we can see the negatives. We can see the negatives. I'm going to bring in this guy here. Okay, so there's the 0%. So anything below 0 is negative. So you can see for the whole of the COVID period, we were under 0. So here is where we're going to lockdown. That's where we're going to lockdown. Then the Fed goes on to a quantitative easing policy, pushes rates down. Okay, and we can see that there are a number of effects. Okay, so just want to make sure that we understand real rates. Let's just adjust this. Real rates are positive. In other words, according to this measure, if you put your money into a instrument that is just paying interest, you should theoretically be getting an inflation beating rate. Now, there's a huge debate there, okay, because I don't think that real rates are positive because inflation is much higher than what's reflected in here. Nevertheless, let's just add in some instruments here. First instrument we're going to add in, guys, dollar. Let's take a look at dollar, right? Let's bring it in, okay? We'll just put it underneath. All right. And what happens here with the dollar is, here we go, negative, let's put it over there, and the dollar just gets hammered. Absolutely lambasted. Let's make this logarithmic. Okay, and then as we start moving back towards positive, then the dollar catches some traction, moves up, and now we are about, so you can see that the negative rate absolutely hammered the dollar till about this point. Then there was this debate about inflation. If there was going to be a more sustained inflation, then real rates would have to rise. How would they rise? Through central banks' action, right? And then the dollar started discounting. Okay. Let's put in another relation. Yeah, let's put in the DAX. No, let's put in the SPX. SPX 500. Okay, and you can see what happened here. Real rates go negative. All of a sudden, S&P 500 blasts upwards. Now we go positive. What happens to the SPX? What happens to the SPX? It goes down as we go. So why? The question is, why is the S&P moving in an opposite direction to real rates? Because we're in an uncertain environment. Why keep your money in a risky asset class like shares when you can just move it over and earn a real rate? Okay, so that real rate is very important in terms of asset allocation, in terms of money flow. Okay, it's very important that in terms of money flow. Now that we kind of see these relationships, we've got to take a look at what's happening with our real rates. And you can see real rates are falling back towards this key zero. Now, if they go back to that key zero, well, I think we could make an argument. We can make an argument that that's going to hurt the dollar. Okay. We could also make an argument that, well, that's going to benefit risky assets, because why keep your money in something that's not giving you, that's not inflation beating? May as well go and look into something that's got more of a chance of making a real return. Clearly, if interest rates go under zero, real interest rates, why are you going to put your money there? It means inevitably you're becoming poorer because you're not keeping up with inflation. Okay, so this movement here in the real rate, very important for us to keep track of. Now, let's close up everything here, and let's just put in some peaks and troughs here on the weekly basis, because we are at a very, very important point here in terms of technicals. So let's put these in. We'll put in our reference trough, okay, and we'll put in our reference peak. Right, now once you've got that, you can see the real rate is in uptrend from this point. Higher trough, I'm just going to put it at HT. And here we've got the HP. And as long as this pattern is maintained, the trend is up. Trough, peak, higher trough, higher peak. We're in danger of that pattern collapsing. Let's put in a line right here. And you can see how close we are to, I just want to make sure this is, let's make this 7. Let's make it absolutely horizontal. Okay, so this is now a horizontal line. So if it drops below the horizontal line, that breaks the higher trough, higher peak pattern. That means we don't have an uptrend anymore. If we don't have the uptrend, well then, of course, the other asset classes become exceptionally interesting. So you can see the real rates here are at a key inflection point. So that's part one, just to set the tone for the week. Let's take a look at a few other variables that we need to keep our concentration on. Let's go through to the jobs market. Okay, so what we're going to do is we're going to look at initial claims. Okay, so what we're going to do is we are going to add a moving average here. We're going to make it a simple moving average, and we'll make it a 3-month. Okay, so this is weekly data. So to make it 3-month is actually a 13-week simple moving average. So we're just going to go moving average, and let's just adjust this. Yeah, 13. Okay. So what we see here is that the initial claims are above their 3-month average. Okay, so on an initial jobless claims, there is an upwards trajectory. Yeah, we're kind of hooked down. We've kind of hooked down over the last, that's right, 18 July. Let me try. I don't think that's the right series. Yeah, okay, it's fine. All right, so it's hooked down. Yes, of course, because it's printed in arrears. I beg yours. Okay, so the last print does show some sort of moderation over a week, but we're above this this 3-month moving average. We want to just keep an eye on that. As long as we have an upwards trajectory on initial claims, okay, well, that is some sort of crack, some sort of capitulation in the jobless market. Next part of the puzzle, continuing claims. Let's take a look there. Okay. Oh, my spelling is awful. There. All right, so let's zoom in here. All right, so what we have here is a movement up in the continuing claims above its 3-week moving average. Now, this is not quite as severe as the initial claims, and I think this is the key data point here, because if the job market is actually in decline, then one would expect the initial claims to flow through to continuing claims. Okay, in other words, if it's just if the kick up is in initial claims but not really in continuing claims, then maybe there is a lot of movement within the job markets, and there's just temporary initial claims between jobs. So the idea here is we want to keep an eye on this moving average to see if it starts sloping upwards. If it starts sloping upwards, then the job market starts showing signs of degradation, and then we'll keep an eye on that on Thursday. And then, of course, we've got the non-farm payroll on Friday. So we've taken a look at real rates, which do show that there could potentially be a rotation of capital back into the risk markets. We do see that the job market, whilst the initial claims certainly is a cause for concern, it hasn't really flowed through to the continuing claims yet, it does bear keeping an eye on that. So we want to just make sure that the unemployment doesn't exacerbate. All right. The next part of the puzzle, okay, is, well, have we actually bottomed? And this is where it gets quite tricky. Okay, this is where it gets quite tricky. So we're going to go through to our COPOC indicator here, and we're going to take a look first at the DAX. Okay, so the COPOC indicator, we look on a monthly scale. Let's take this moving average out for now, and let's throw in the COPOC. Okay, so it's the first of the month, so this is the ideal time to be referring to the COPOC indicator. And let's just make it easier to see. All right, so the COPOC indicator, there's two important developments that we need to keep a lookout for in terms of the COPOC. So the first is has it dropped below zero? And the answer to that is yes, on the DAX. Okay, so the second is, has it turned up? And the answer to that is no. Okay, so let's actually put in a signal line here. I'm going to put in a 9-month exponential moving average. Just going to use it as a signal line. So we'll just add an indicator here. We're going to make this an exponential. Okay, and we just want to make this a 9 period. Okay, 9 period. It's actually going to lag too much. Just make it a 3. Okay, so just using the too much red. Okay, so just looking at the COPOC with its 3 period exponential, let's take a look at all the positive crosses here. Okay, here's one. So, and remember it's monthly, so we get a nice, probably about a year, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 10 months there of nice up move. Let's just move this one over. 1, 2, 3, 4, 5, 6, 7, 8, 9. 10 months of nice up move there. Here's a nice one. Okay. Here's a nice one, and here's a nice one. So you can see in terms of reading the bottoms, okay, the cycle bottoms, COPOC's doing a pretty good job on the DAX. But the key here is we've got only one of two, don't we? We've got the movement below zero, okay, so we can check that box, but we don't have really the cross up over the 3 period. So there certainly has been a good month on the DAX, and we can see that's this candle over here, certainly a good month. But you know, there was, let's just go back to some. Okay, so here's the 2008 crisis. So we had 2 good months here, right? Got two good months here, 1, 2, but it still carries on going down. We've got a blue month there, carries on going down. So just in terms of the COPOC, while it's not going to get you the absolute bottom, okay, it's really a pretty good indicator of identifying when we have bottomed, when we have turned, and it just doesn't seem that we have that signal. Now, it doesn't mean that we haven't bottomed, because inevitably the COPOC will be slightly late, won't it? However, okay, if you are concentrating on risk over reward, there is a risk that we still got some downside here, according to Copac. We haven't bottomed. Now, let's just marry this with the real rate. If the real rate goes back up, in other words, the series of higher troughs, higher peaks continues, then we probably see the Copac carry on moving down. However, I would suggest, okay, that if those real rates do drop below zero, that would be a suggestion that maybe the Copac is due to turn up. Okay, now let's go back to real rates. What's the big deal here around real rates? It's this weird comment by Jerome Powell. We're at neutral. Gee, I don't see how that's possible. I'm just going to bring up Forex Factory. I didn't put it on my slide of sources. Okay, but if you take a look at the core PCE on a month-on-month basis, that's higher than forecast. You're telling me that there's not going to be I think we're at least 50 basis points away from possibly talking about neutral, you know. So and I would suggest maybe another 100 basis points. I'm just sort of guessing, but another 100 basis points to kind of get the to get this control. So what happened last week is that there was a tug of war. There was a tug of war between recession risk and inflation. So this now needs to also be a theme that we look at during this week. So I'm just going to bring up my Microsoft Paint. And we've got two variables at loggerheads with one another. Okay, inflation versus recession. Remember now we've got two quarters of contraction. Okay, so what's happened now is that the market needs to decide which is going to be the priority for the Fed. If recession's the priority, then that real rate does drop below zero. So then we do get, and then possibly the Copac bottoms, right? But if inflation's still on the agenda, then I think that we're not done with these rate rises yet, and we might get something like this. We might get something like this on that real rate, and then, well, the Copac is perhaps going to move down further. Just one other chart we must look at in terms of Copac, and of course, we must look at the US indices. So let's just take a run through of the US indices. So we'll go through the US 30 first. Let's just get rid of this. Let's get rid of that. Okay, so we're very close to going negative here. Very close. Let's just take a look at SPX. Again, very close, not quite as close as the Dow, but we're getting very close. Let's pin the zero here. Okay, so very close. And let's just take a look at NASDAQ. Okay, so NASDAQ is in that value territory now. Now we just got to see if it's going to turn up, right? It will turn up if those real rates come down. Okay, but what we want to do is, so we are getting, if we haven't hit bottom, we're getting pretty close. But the fact of the matter is, COPOC hasn't turned up yet. COPOC's going to be late. You've got to be comfortable with that. Okay, but it's more accurate. Well, not more accurate. It's safer. I beg your pardon. Is the more correct way of approaching. All right, let's do some analysis just to let's just do some analysis on the so I've got somebody's mentioning my name, but the asker is not being identified. Is that you, Anna? I'll just wait to see if something further comes through. Hey Anna, okay, cool. All right. Oh, she meant the index. Yeah, well, so I thought you were putting. All right. Let's take a look at. For this one, I'm just going to use the RUT because the US 2000 may be limited in history. We'll just use the trading view CFD here. Okay, and we are at minus 18. Okay, so I think that these growth indexes, NASDAQ, the Russell, very interesting. Again, I think it's going to play the way the real rates here are going to play a huge part here. Let's just add. Let's just add the real rate here. Right, let's just make this a real rate. Okay, cool. Let's add that in. Let's put in our vertical. Okay, there we go. So you can see NASDAQ coming down as the real rate moving up. See that? So if this, I think it doesn't look right to me. No, that looks right. Okay, sorry, we're on the monthly chart. Okay, so if we drop below 0, let's just put this 0. Let's put 0 in here because I think it's important. Okay, so if we drop below 0, maybe we get the COPOC starting to push up, and then this actually turns into a really good situation to analyze. Let's go back to NASDAQ. So that was the Russell. Let's take a look at NASDAQ. Okay, now watch NASDAQ with the real rate. Okay, you can just pop it over. It's a couple of months different to the Russell. So the Russell reacted first. Okay, I think it was Chris who mentioned is the Russell the leader, and it is certainly because you can see we've had to move our horizontal bit forward, but the decline in NASDAQ coincides with the appreciation in the real rate. Now that the real rate is looking flimsy, we'll take a look at the COPOC indicator. Okay, take a look at the COPOC indicator. So we're just waiting for that to turn up. Okay, and we've got the Dow Jones really close to being 0, and the S&P not quite there yet, but very close. We're, I think, 4 points away. So we are getting to this point where I think we are going to find value. I'm not convinced we're there yet. We certainly may be there. We certainly may be there. But you know, the COPOC, in my opinion, should turn up. Yes, we'll be late, but it will be more appropriate in terms of a risk-adjusted type of analysis. I had a terrific week off. Thank you very much. It was absolutely terrific. Nice to be back though. All right, let's just end off with some analysis here, just to set the tone for potential positions. All right, so we can see that the on a broader scale, the indexes are starting to show signs of value. We could also see that the asset allocation, okay, driven by real interest rates, might support that. It very much depends, I think, on this inflation versus growth and this neutral rate, which we certainly can't be at neutral now. So that's sort of the bird's eye view. Now, as traders, what are we looking at? So, well, the COPOC indicator for DAX certainly indicates value. It hasn't turned up yet. That means it can go down. Well, we've pulled back. Okay, so we've pulled back, and we want to just keep an eye now on the peaks and troughs. So let's get rid of RSI here. I don't think we need it. We can see that the stochastic, so just take me down to this, has moved upwards, so that, which makes sense because there has been a bounce here. We are moving up towards the 62% retracement of our last leg down. I think it's worth keeping an eye on that. If that 62% does prove to be formidable, then perhaps we do get that lower peak. Perhaps we do get a bit more pain. I don't know. I'm just saying perhaps, just while the US 30 and the S&P 500 catch up to that COPOC value level. But we'll see. I mean, that's pure sort of hypothesizing. So we just got to keep. So we can see we have got a movement up here on the weekly. Let's go to the daily. So you can see on the daily here, there certainly is positivity. Okay. Now I just want to link daily with weekly here. Okay. So there is positivity on the daily. Just be aware of this 62%. Whilst I don't think that there is inherently any magic in a 62% retracement in terms of Fibonacci numbers being part of a cosmic order, I think that's ridiculous. I do think that there is a number of traders that potentially will be targeting the 62%. So that's my concern. If it goes above, well, then that's actually a positive. That's actually a positive sign, because it means that the traders aren't targeting 62. They're potentially seeing a bottom here, right? So if we get above the 62%, that would be the I think a tick on the bullish side. So just keep an eye on that. We have gone into zone 1. Take a look at stochastic. Okay, so a week makes a difference, right? It's now really gone into this 80 area. It's showing some really nice momentum. Let's go down to the hourly. And what you can do here is keep an eye on our triggers. Trigger 1, trigger 2. Okay, so trigger 1 looks like it's about to pull. Is trigger 2 going to pull? Okay, now if we get those triggers, fair enough, but nothing's going to happen until stochastic gets here. That's the key. That's the key. Take a look at the last time stochastic got there. Take a look at the last time stochastic got there. Okay, had a really nice run. Thank you, Anna. I really appreciate that, and I missed the webinars as well. I enjoyed them tremendously. All right, so we've got the potential setup here. Okay, we're moving towards resistance. Okay, there is a pickup in weekly momentum. This resistance just needs to be watched carefully. Is it going to be targeted by shorts? If it fails, I think on a sentiment basis, that's really good news, considering where COPOC is. Zone 1 looking looking really good. In fact, volume just starting to pull away. Stochastic showing nice momentum. We are lining up in what looks like it's going to be a really interesting potential here, but there's no guarantee. So depending which way, if you're going to go long or if you decide to fade it, always use a stop loss, but nothing's going to happen until the momentum holds. Let's just take a look at Euro US dollar, and I think that's where we will conclude. So just bringing that up. All right. So these lines were drawn in actually prior to me taking the week off. You can see that the stochastic is pushing up out of 20, so there is some sort of resilience. It's still weak. I mean, it's really not showing the kind of support that we're seeing on the DAX. Okay. Let's take a look at this on the daily, and this is a tough chart. I would perhaps look elsewhere. I'm just talking personally. I don't want to give advice, but I mean, I can't give advice, but on my personal account, this looks like it's setting up for something. There's a squeeze, but the volatility is not there. Volatility doesn't look as if it's there right now. So DAX is looking interesting. Euro, I'll keep on the watch list for now. I think that one of the requirements is to get into this 80 area here, hold, and then we probably see the Bollinger's expand upwards, and we go into that zone 1. And I think that's where we can stop for today. We'd be going quite. We did a number of, I think, important themes that we're going to keep our eye on. And you can see that there does potentially seem to be this pivot. Now, I don't want to get ahead of myself because we don't know if we've bottomed until after the fact. So I think the COPOC is going to be important. I think keeping an eye on the real interest rate is going to be important. I think keeping an eye on the labor market is going to be important, as long as it remains sort of steadfast. And it seems to be. In other words, we haven't seen that flow-on effect into the continuing jobless claims. I think that's a sort of a bullish sign as well. I think a sign of positivity. And of course, keeping an eye on our inflation numbers. All right. Did I leave anything out? Is there any other questions? Please let me know before we sign off. All right, nothing coming through. So I'm going to sign off here just before I go. So Anna, I'm going to assume, Anna, that you are getting the emails now, right? So that's all sorted. Just want to double check if there's any issues with that. So just let me know. But okay, awesome. All right, guys, let's wrap up. We'll chat tomorrow morning. Thank you very much. Thank you, Rob. Thank you, Rob. And looking forward to this week. Okay. Speak to you guys tomorrow.